Well, good day all. Ira Epstein with your Spider ETF stock market wrap-up. And this wrap-up is for Monday, the 9th of January, 2023. So the first statement I have, I will be doing these updates tomorrow, but you won't have me Wednesday, Thursday, or possibly on the weekend in the studio. It's my birthday. My wife's taking me out of town, so away I go. I'm very happy about that. Well, people at the house and so on, but what the heck. Nice of her to take me, and somewhere I've never been, out of the country for just a couple of days, but it's going to be a lot of fun. Now, let's talk about what we've got going on. First off, I think we have to talk about last week. It was the labor market week. We saw that the market embraced one thing. It didn't care about the JOLTS number, which showed still more jobs being offered. It didn't care that ADP saw a monster number of new jobs. It didn't care about Challenger Gray Christmas, seeing corporate layoffs about half of what they were the month prior. It cared about one thing, the jobs report, but not that the jobs report showed more jobs more than the consensus. It cared that the rate of increase in wages slipped. It picked one thing. The market is determined to try to pick a bottom in the market. The market is determined that Fed Chair Powell will crack under the pressure of a slowing economy. I am not in that camp yet. Here's why. When Fed Chair Powell speaks, he mentions Paul Volcker. Just go back and read his speeches. He doesn't want to be the person that in schoolrooms they talk about him as having done the same mistake that Volcker did, which was he cut rates and he had to go back and raise them. He's going to be certain that this inflation genie is in the bottle. Understand that while there's an FOMC committee, one person makes the decision. He doesn't have to listen. Everybody can say no and he can say yes. You do understand that. Therefore, you'll have to show me now the other shoe, which is the CPI. In other words, price inflation. We get our first big number this week, the end of the week. Is it going to come crashing down? Well, if it does, that gives some good news for reasons to be saying, okay, maybe we don't have to have all these price increases, and not price increase, rate increases, as Bostic is saying, as Daly is saying, as Bullard is saying. I can go on and on. Rather, the market will say, we see it now between wage increases dropping and maybe even down the road going to a negative. They don't have to go up at all. And with CPI coming down, game over. But what if CPI comes in stable or higher? That just prolongs everything. So unless it comes galloping down, which is always a possibility, I want to hold back on making any decisions. I think it's fool's play to try to figure out what's going to happen 11 months from January. Absolute insanity. Take it a month at a time. You don't have to be the first guy on the street to get long. Trade the individual stocks as you see, trade the ETFs as you see, but don't get a predetermined idea. That will hurt you in a major way. Got it? That's my words of wisdom. I'll stay with Costco until we finish up now. There is a gap in the chart. It could be filled. So if the market wants to come back down here, that is the zone that it can do it. When we take a look at patterns, you don't have a bull pattern. You have a lower low, higher high. That is not a trend. Number two, the market just shot through the 18-day average. Unusual that it does that without coming back to challenge it at least one time. That's my thought. And where did the market stop on this rally? If you haven't taken my enhanced Bollinger course, shame on you. You need both hands to trade. I teach you how to work with Bollinger Bands in a way that I've never seen taught. That doesn't mean somebody else can't come up with a way, but I know I'm the first to do it with the slow stochastics, with my formula in it, and this. That is me. And all my work said today when you got up there, no, No. This is not where you want to stay long. You hit that number, you went through it by $1, and you came crashing back down on it. The market momentum is up, the bias is up, but you already hit your upside target. When I look at LIT, you've had your bottom in place now. Now, what do I mean by that? Well, let's you and I step back here and go right here. There we are. This is Thursday's action. Here's Friday's. You lose the embedded reading. Price should go to the 18-day average of closes. That's what I teach. Tell me what it did. Bingo. It's exactly what it's supposed to do. Now you're neutral. You've left this big washout. You may have a major bottom in place. Time will tell us. But being short, that's off the table now. You've had your big washout in this market that's gone from 75 to approximately 60 and has now gotten itself out of that part. When I come to Apple, what do you think I'd tell you on a day like today? You had lower highs, lower low until today. That's why I left that there. Now you have a higher high and a lower low. It's not a trend. What else here? What happened last week? Let me see. Here's the market. This is the market on Friday. Agreed? January 6th. You lose the embedded reading. You got a 23 reading. You should make a run to the closest main moving average. If you don't believe this stuff as I do it, what's wrong with you? You take that enhanced Bollinger Band course. It's on our website at iraepstein.com under the word education. Got it? It's pretty simple. It will stick with you. I use it futures. I use anything that you can chart, I use it with. Isn't that crazy? And I stick with it, believe me. Once I learned it changed my trading life and my analysis life, if you will, in these markets. AMC, I just can't get friendly this. Now, I'm the first to tell you there'll be a number that, hey, unless it's going bankrupt, it's got value in it. I don't know what that number is. The trend is still down. It has an embedded reading. The pros are still going to sell short until that red number gets over 21. And the next downside, if they can get it there, is 322. When you look at XLF, the one thing I've been saying is, all right, come on. You've got earnings right in front of you. They start this week. All the big boys, the big banks come out. We're already getting warnings from a number of companies warning you that sales aren't what they should be. Do I have to tell you Macy's, Lululemon? I can go on and on with the names. Well, there'll be the others that are coming out. Now we're going to start hearing from the banks. The fact that Goldman's letting go of 3,200 people should tell you something. It should tell you that they are major concerned there's a serious problem in the market, right? We then look at XLI. In an XLI, we have higher lows, higher highs, and the market is fighting a major battle at the upper Bollinger Band. We then go to XSD. Higher lows, higher highs, market coming up. Could be going all the way up there to the upper Bollinger Band, not quite certain. We'll have to wait and see. XHB, the home builders, that's probably the zone where the market's now got to figure out what's the next move. It's had a nice run. It built that run in part on the idea that long-term interest rates most likely have seen what? Their peaks. I can live with that. I can live from the 20-year on that we're not going to get much higher rates than we've seen. In fact, I don't think they'll go back to those numbers. It's the short term, the 2-year, the 5-year, up to the 10 that should have the pressure in the market. The 10 is part of the number that mortgage rates look at. So you've got to understand you're right at that area like that. In the energy sector, okay, we've come back up to the upper band. So we've gone from all purposes, from the lower Bollinger Band to the upper band, trying to drop back down. We're neutral. We're going to spin in here, I think, for a little bit now. Just going like that as the market tries to develop and buy some time. China's going to get the worst of the COVID, come out of it, and they're going to buy everything. I wrote this morning, all the new things that they're doing in these markets, they are coming out with packages galore. So will they consume more energy is going to be the big issue. And will Russia cut back on some of the energy it's producing, changing the supply demand? I think it's in a tenuous position. And I think down the road, we have an energy problem to the upside. That's still my bet as to what's going to go on. In the gold market, I think gold's looking at the inflation down the road from that. It's looking at a dollar that is weak. The dollar was very weak today. And that has been what's got gold going. It's not the Ukraine war. It's not the inflation story. I know that sounds crazy. It was the weakening of the dollar. Recognize that if you have to, put a dollar index over the gold chart. You can put one on the other. Take a look at how they look. You get the story. In SLV, you're neutral. You've got a higher high, lower low going sideways, and that's fine. Then we get to copper. This is my favorite metal. I think that copper in the end of this year, sometime next year, could easily be a $5 a pound item. I see cutbacks in supplies coming out of Chile, Peru. I see the big companies trying to get 30-year contracts to lock in their copper. And I see every electric car needs a lot of copper, more so than you would think. Fewer moving parts, more copper. I don't know. To me, it's a lot of demand, and I don't see a lot of new copper mines coming online. TLT, higher lows, higher highs. By the way, save your pennies, right? And away you go. By the way, there's another thing. Remember the January effect. You've got the first 5 days of January where traders look at that, and we had an up period, and they'll say, that's it. I saw Tom Lee from FactSet today saying, we will be up 20% by the end of the year minimum in the stock market. NASDAQ could be up a lot more than that based on that. Well, there's that. That's the January barometer, by the way. Then you have the January effect. There's a difference between the two. One's the first 5 days, the other's from January 1st to the 31st. They both have probabilities in the 80% right area, just so you know. That also means they're wrong 20% of the time. I think it was 2002 they were wrong, and 1970 or so they were wrong also. So you look at these things and you just keep it in the back of your mind. This market's dying to be bullish. Do you disagree with that in the stock market indices? If you do, where have you been? The market fights the battle. It goes up and then all of a sudden it falls back and you fight. The one thing I am going to tell you, over the weekend I was looking at the analysis and I kept coming to one conclusion. When we eventually went back down for the June lows, and I told you we would do that in these videos, and we did it well after the fact, right, that I said it, it didn't go anywhere. So even if it goes down there again, I don't think there's as much big downside in this market as there is a technician there could be, and I understand why. It's a strong labor market. The only thing that can change my thinking on that would be a weak labor market going from the extreme strength that we're seeing to one that flips instantly on you and gets very weak. If that happened, all bets are off the table. I don't see that at this point, and I don't see a reason that should happen. But if it did, be aware of it and always have your escape plan in the back of your head if something happens. And if you can't remember it, write it down. TLT, well, what the heck? This is the 20-year on bonds. I'm in that camp. I'm bullish. I don't think we're going to go back to the high rates we had in the very long-term instruments. We're already talking, where's the Fed going to fade and stop at 5%, whatever the number is. That's not going to carry those numbers up there. Keep that in the back of your mind. It shouldn't. Can it? Of course, but it shouldn't. Then we go to the dollar index. Well, what do you do when you get down to a Bollinger Band? Take that enhanced Bollinger Band course. What did today scream at you? You should know the answer to that, and it's the flip-flop in the FXE. What did I do today? What was I looking at in the markets? I can tell you. The markets that I've been getting trades in, by the way, have been the Spiders ETFs galore. A lot of trade recommendations have been coming out of me since the first year. I haven't had a trade yet in the futures market to put out this year. I will. They'll show up on the charts. But I was looking at pivot points all day and going, okay, here we go. Is this going to work with my ideas or not work with them? What a pivot point does is it looks at the previous day's range. There's a formula. I didn't write it. It's been around. And there are some excellent people that have used this for years. I had a gentleman manage money in my companies in the 80s. And I never saw anybody make as much money as this man actually made. He wrote a book how I made $1 million trading off, $1,000 or whatever. He didn't write the book how I turned $1 million back to near nothing. But what broke him wasn't this. What broke him is he got bigger than the market. He had my firm. There were three of us very large firms in the 80s. I was one of the largest discounters in America, by far one of the very largest. And I mean right up there in the top 2, 3. And to make a long story short, you get bigger than the market at that time. Well, the markets have changed. But you don't forget these formulas. Just because he got too big doesn't mean that the formula doesn't change. You take his equation out of the market, and away you go. And size does matter. And that, by the way, taught me size. Size can move a market. So if you're a hedge fund working billions of dollars, you have to trade different than if you're trading your whatever you have in your account. Very different. Understand that. And this formula taught me that there's nothing wrong with the formula. The size of somebody moving all at once, there was. And from that, you learn how to use the sell and the buy points, because that's what it's about. You'll get your midpoint, sell points, buy points under the market. I tied, and I kept saying it's missing something. And once I learned how to modify the slow stochastic, I applied it to this, and I saw something develop very clearly. I teach that for free in this course, and the word is for free. So if you haven't seen this, what do you have to lose? You'll see the way that I teach. It'll get you into the enhanced Bollinger Band course, maybe the outside day course, which you're getting all kinds of signals off of that right now. It's a 3-part video, and it is video. I don't believe in writing anymore. I can make it so much easier with videos. How do you get it? Go to our website under free offers. Now, TubeBuddy, which we use on YouTube, normally puts up our icons up here. We're having trouble with it. It's their software, not us. If it works, just move your cursor, and that means we've got something fixed. If not, because I don't know if it's working tonight or not yet, just go to our website under free offers, or give my staff a call tomorrow. They'll make sure you get it. I'm Ira Epstein. You have a great day. I'll see you all tomorrow. Take care.